Okay, we'll now check out the overview of hedge fund, and this is portfolio risk management for FRM part 2. Hedge funds have exploded popularity between 1990 and today due to influx of institutional investing. This increase has led to more structured products in the financial area. While hedge fund investments tend to be less liquid, their performance has compared favorably with traditional equity investment, and this has been achieved with a lower standard deviation. For example, understanding how hedge fund performance and fee structure compares and contrasts with traditional equity is something we are going to look at. We need to understand a few terms like side pockets, lockup gates, and know the arguments for and against funds of funds investing. So let's look at some of the common characteristics attributed to hedge funds and how they differentiate from standard mutual funds. Common characteristic of a hedge fund includes, and there are six: no investment restriction. They can take long or short position. Typically highly levered. Take large bets which magnifies both gains and losses. Unregulated, little or no regulation. Tend to be illiquid. There are usually lockup period with time restriction on investment withdrawal. These could last at least 1 to 2 years. Illiquidity continues after lockup period due to gates or quarterly limits on investor withdrawal. Limited to wealthy investor, endowment, pensions and institutions. Other may participate through fund of funds. Lack of regulatory restriction allow hedge fund to attempt a wide variety of investment strategy and make quick changes based on changing market condition. Hedge fund attempts to achieve absolute return, not correlated with traditional stock bond portfolio. This can be attract this can be an attractive diversification benefit since hedge fund borrow heavily, losses and gains are magnified. Hedge fund investment strategies. Explain the investment strategy used by hedge fund to generate return. Hedge funds are highly levered and use many methods to achieve their return. One is bank borrowing. The other is repurchase agreement, and the third is short selling. So they could do anything. So repo are cases where hedge fund agrees to sell a security for a pre-specified price and then purchases back the security at a higher price on pre-specified future date. Short selling, and let me help you why this repurchase agreement comes into play, because suppose you have got some assets with your hedge fund has got some assets that it has invested, so it will and it wants to actually hold on to that asset, but it also wants to make some bets, so it will be actually giving this as a collateral and getting the money and signing a repurchase agreement to buy it later with a price, and it will get the money and it can then use that money. Hedge fund can often increase risk in a particular asset using derivative. Hedge funds may also make investment in high risk portfolio in structured products including collateralized debt obligation which contains leverage within the product themselves. Hedge fund implied ratio is computed as total leverage plus assets under management under assets under management. For hedge fund, the ratio ranged from 2.9 in 2004 to 3.4 in 2007. Leverage includes leverage to derivative position and debt. Now we look at hedge fund growth. Describe how hedge fund grew in popularity and their subsequent slowdown in 2008. Hedge fund growth between 1990 and 2007 was astonishing. In 1990, there were 530 funds with $39 billion in assets. By 2007, the funds grew to 7,600 with 1.9 trillion under assets. This was due to investor desiring more diversification, investor desiring absolute return, overall growth in institutional investing, favorable market condition, talented manager, hedge fund abilities to execute complex strategy. Top performing hedge fund consistently outperformed US equities, bond and other hedge funds during 2001 to 2007. In 2008, however, a historic decline in worldwide equity credit caused many financial assets to precipitously drop in value. When a large group of hedge fund investors made requests for withdrawal in third and fourth quarter 2008, many hedge funds could not meet the demand and were forced to make emergency liquidation at the distressed prices. In fourth quarter of 2000, hedge fund redemption topped 152 billion. Despite of 2008 poor performance of hedge fund, they still outperform S&P index by plus 19%. Recovery ensured in 2009 and second quarter of 2009 saw the first increase in hedge fund since mid 2008. All return increase were due to investment gain. Hedge fund fee structure. Fee structure for hedge fund and the use of high watermark and hurdle rates. Hedge fund typically have a management fee and a performance fee stated as 2 and 20, meaning 2% of the net asset value, and management fee as a management fee and 20% of increase in NAV as per performance fee. A high water indicates that performance fee only applies when once the losses from the prior are recovered. Similarly, hurdle rate might be a plane which limits the performance fee, making it payable after a specified hurdle is cleared. Fee for hedge fund manager are much higher compared to traditional asset management. Similar to hedge fund fee, private equity manager can also earn high fee based on performance. Hedge fund historical performance. Academic research on hedge fund performance. Between 96 to 2006, hedge fund annual return after fee only slightly exceeded broad equity market. Average returns were 10.6% versus 8.1%. However, these returns were achieved with much less standard deviation, 2.1 versus 4.2. Between 2002 and 2008, the top performing hedge fund outperformed the HFRI fund weighted composite index by 46%. Thus, there is significantly advantage in finding the top hedge fund and making timely investment. When evaluating performance, it is necessary to understand the biases that result from adding and removing funds from the database of hedge fund. And there are two biases: survivorship bias and backfill bias. Survivorship bias occurs when funds are dropped from the database when they are liquidated or fail. Backfill bias are when new funds are added to the database and include only positive prior returns. So when excluding these biases from 95 to 2000, a compounded annual return of hedge fund was 9% versus S&P average return of 11.6%. Overall, hedge fund performance has been best during bull market. It is critical to examine absolute return, hedge fund generation of alpha. Academic research show that fund of funds do not generate alpha, and 3% of annual hedge fund return can be attributed to alpha. Financial innovation bought by hedge fund. Explain how hedge fund help progress the financial market. Hedge funds trade frequently and account for 1/3 of trading in many equity and debt markets. This has increased global market liquidity substantially and produced many new and innovative hedging vehicles designed to lower investment risks. The increased trading has also reduced pricing inefficiencies. For example, credit derivative produce have grown significantly. Hedge funds have been large purchaser of ABS and CDO. A byproduct has been banks have been adopted to lend since they can take credit risk off their balance sheet to the use of these type of products. However, in 2008, when there was a collapse in mortgage market, in part due to credit extension to parties unqualified to receive credit, hedge funds and credit derivatives took the major of blame. Financial innovation developed by hedge fund and the resultant new products like total return swap, credit default swap have permitted exposure to assets that were not previously accessible to hedge funds. Risk taking also increased due to financial innovation, so there is an ongoing debate whether the benefits of these products outweigh the risk that they have created. And there is a debate whether or not benefits of all products outweigh the risk created. Hedge fund liquidity. The liquidity of hedge fund, lockup gates, side pockets. Lockup period is the period that an investment may not be withdrawn from the hedge fund. It is typically 1 to 2 years. After the lockup period expires, there is usually a gate that limits the amount of withdrawal during quarterly or semi-annual redemption period. This protects existing investor. In perhaps 20% of cases, hedge funds become illiquid investment that they can be extremely difficult to value. In the case of hard to value, illiquid hedge fund may use a desirable side pocket investment, in which the new investors are not permitted to share in returns from this particular asset. So, this is an issue when something is hard to value, and most of the times in an illiquid scenario, and they are designated as side pocket investment, in which new investors are not permitted to share in return from this particular asset. Management fee on side pockets are based on initial cost rather than mark to market value. Comparing hedge funds to private equity and mutual fund. Both hedge fund and private equity funds are lightly regulated. However, hedge funds usually invest in liquid asset while private equity invest in less liquid asset, such as position in entire companies which can tie up an investment for 3 to 7 years. Mutual funds are entirely different, offer intermediate daily liquidity and NAV prices daily. Mutual funds are heavily regulated by SEC. Also, managerial fee paid to mutual funds are substantially lower than fees paid to hedge funds and private equity. Lower fees are generated by lower returns, which implies lower risk. There are some mutual funds which have outperformed, which have performed performance-based fees. Sorry, and they are rare. Funds of funds hedge fund. Describe fund of fund hedge fund and provide argument for and against using them as an investment vehicle. Fund of fund investment is an investment fund which invests in other funds with no direct investment in the market. Fund of fund manager receives 1 to 1.5% of management fee plus a 10 to 20% in performance fee. Due to layering of fees where a fund of fund collect fees from investors and then pass investment to hedge funds, the total fee paid by fund of fund investor can total up to 3.25 for manager fees and 35 for performance fees. This produces a tendency for fee to outweigh any investment benefit. However, fund of fund can be advantageous for high net worth individual because of the value added of due diligence process performed by fund of fund manager in which they identify poor hedge fund manager. They use extensive network of contact and have staff resources and expertise to monitor performance and make judicious hedge fund selection. This due diligence is not without fault. However, for example, a number of fund of fund invested in Burning Madoff funds. Advantages of fund of fund include instant diversification with low capital requirement and select hedge fund manager or fund which are otherwise be closed. Hedge fund manager welcome fund of fund investment since they are typically large source of cash and tend to take a short term view in investing. So this was about the hedge fund part for the FRM part 2. I hope this added something to your knowledge base. Thanks for listening.